Thank you for joining us today, everybody. We appreciate you taking some time out of your busy day to join us for this session today. We're going to be talking about transitioning your business, trends and impacts for 2021. This seminar is co-sponsored by Vinoble Group, an independent financial services firm, and Private Practice Transitions, a business brokerage and consulting service. My name is Brian Mahorek. I'm one of the co-owners of Vinoble Group, and I'll be serving as your moderator today. Our presenters will be Brian Johnson, the CEO of Vinoble Group, and Justin Farmer, the president of Private Practice Transitions. Brian and Justin have known each other for years and have worked together on several mutual clients. And Justin also helped the Vinoble Group acquire 2 businesses last year, so we've had an opportunity to see his work firsthand. Transitioning your business. That can feel a little bit daunting, but the sooner you start the planning, the better. Our agenda today will cover some of the key issues to consider as you start to plan your exit strategy. With that, we'll get started with my awesome business partner, Brian Johnson.
Welcome, everyone. It's great to have you here with us. The first thing I wanted to start with was really taking a 30,000-foot view on how we might approach, financial management. And really, it's what we consider to be comprehensive wealth management or long-term wealth planning. What you're looking at here is really an illustration of the various pieces of your finances. And the point of this document is really to show you that they're all related. Meaning if we change one thing, it'll affect something else. So case in point for today's conversation, most of you, the business is your largest asset. And when we sell that business, there's a transaction that takes place there that obviously will affect your tax planning. It'll affect your personal financial goals, likely your portfolio strategies, and so on and so forth. So having the understanding that these things all impact one another is critical when we start to think about how do we really plan for transitioning the business. And Justin will talk about more of the planning side of it leading up to setting your business up for sale. What I thought was helpful was if we were to look at a particular scenario of a client and walk through both the qualitative and the quantitative components of it. The common question that we get first is, what's the business worth? And this is really the value that goes on to your balance sheet or your net worth statement. And there's different ways to value this. Again, Justin will talk to those in a little bit, but that's one of the common questions we get. I think the more important question is, what does it need to be worth? Or sometimes, what's your number? So if someone were to walk down the street and say, I'm going to offer you X amount for it, would you take it? Or do you even know if you would need to take that figure, or it should be higher or lower? And so that's critical to define. So we'll go through that process. And then certainly legacy planning. How do you plan to transition the business? Is it going to be something that you sell to your employees, a family member, or a completely separate third party? And what's that process? So let's take a look at a case scenario here. Give me 1 minute to switch to my screen. And we're going to start with defining the goals of this particular couple. Now, these clients are 61 years old. They have 3 kids, 2 grandkids. And as I mentioned, like most business owners, the business is the largest asset that they have. And so they're really relying on the value of that to get them into their retirement. So we want to start with, let's defining the retirement and the goals. And more common than not, spouses will have different goals and different priorities. And this is the exact case that we're seeing here. So retirement planning is number 1 for both of them, but then you start to see diverging goals here taking place. And really common now, of course, is adding in caring for parents in addition to what we consider to be normal goals like retirement planning, education, maybe some philanthropy. So that's something we need to be aware of. And so we've qualified those goals for them. And it also forces the 2 individuals to have the discussion as a couple, which I think is also imperative when we get into really what our decision matrix looks like. So now that we've defined what those goals are, we can shift more into the asset side of things, meaning, okay, what do they actually have that's available to them to achieve these things? What I've done is I've initially put cost to the goals that they're talking about. So you can see this support for an alien parent. We have annual gifts to the kiddos. We have gifts to charities. They also have college goals that are in there, and lifestyles. So they want to join a country club. The cost on this, you can see down here. So we've targeted a cost to it. And now the question is, well, how do we cover that cost? So the first thing that we talked about was, well, where do they want to live? And in fact, they want to downsize their property. So we can add that into the equation here, where we're selling their $2.3 million property and repurchasing a $1.5 million property. So that's bringing equity into their portfolio, which is illustrated by these green components of each bar, if you will. Okay. Now we can go to their other asset, being the business, and trying to pinpoint a target for it. So what happens if we sell the business at $6 million? What does that do for us? And what we'll see here is a reflection in terms of how far their portfolio will carry them out. Now, this is their portfolio, not their net worth, but it shows accessible assets that they can use for spending. So in this situation, it seems like a $6 million sales price might make sense for them. Now I'm going to geek out a little bit and talk about the math behind this, because it's important to understand this is just one way of calculating. This is using what we call a straight line method, meaning it's taking the set variables like their rate of return, like their tax rate, their inflation rate, so on and so forth, and simply carrying them forward mathematically. That's all wonderful, except we know we don't live in a world like that, and things change. So what we also want to do is test it against a probability scenario, what we call Monte Carlo. So we're running 1,000 different simulations in the market to say, well, what happens if the market performs subpar, average, and above average? And what you'll see down here is a probability of success of 80%. That's a different story than what the straight line calculation tells us. Ideally, we want to be 90% and above. So what I would suggest then is that 6 million, it won't actually get us to our goals. But what happens if we settle at 10 million? And does that give it enough target here to achieve their goals from purely a probability perspective? So we'll let this run here. Sometimes it takes a second, and then we can discuss the outcome. So 99% probability of success. That's a pretty bulletproof scenario in my mind. So then what we do is we look, well, what other toggles can we change to optimize the scenario? Well, what happens if we delay Social Security? And why might we do that? We have so much capital that's come in that we simply don't need the fixed income at their full retirement age, or 66 2/3. We can push that out to their max delayed credit, which is now 71. That actually adds value to the equation. We can also say, well, your portfolio has a certain risk and return associated with it, about a 6.5% assumed return right now. Do you need that risk? And what happens if we reduce it? Are you concerned about market volatility? So in this scenario, I'm dropping that risk to 5.5%. So I'm taking 1% off the table effectively by changing it from less equity to more fixed income. And that gives a little more stability in their retirement with little to no effect on their probability scenario. So you can see how all these things interact. And then again, going back to our slide deck where we were talking about the wheel and how those things can affect one another, you can see it play out in real life decisions. Other things that come into play here is timing. Part of the illustration has to do with when do they sell the house and when do they sell the business relative to things like Medicare. So Medicare, you're eligible at age 65. And the way the premiums work is they look at your tax return from 2 years ago. So what we want to try to avoid is selling the business any later than 2022, because that's going to increase their Medicare expenses. On the same token, if they're selling their house and they have capital gains in there after their exemption of 500,000, we have to be careful with when we time that. So in this particular model, we're having them sell the house in 2021, realizing the capital gains there, and then selling the business in 2022. And then their Medicare eligibility for the tax return is 2023. So you can see how those things need to be aligned and work closely with it. So that's a good intro to really the qualitative and quantitative side of how we suggest you look at planning. Justin's going to talk about really the tax side of it, the deal structure, and some pitfalls ultimately leading up to how do we move forward in planning for a business transition.
Thank you, Brian. Well, and thank you everyone for joining this morning. I'm happy to jump in and just start talking about practicalities as it comes to you considering your business as an asset and succession planning. And so, piggybacking off what Brian has just said, I think one of the key components to your long-term business plan is determining whether or not, when you're ready to sell or ready to retire, you do have enough in your in your piggy bank, as it were, to live that retirement life to the best of your ability and kind of what your goals are. So I always start off with asking clients, how much longer do you need to work? How much longer do you want to work? And how long would you be part of a transition? Those questions will help you understand, okay, how much more from the business can I be giving to someone like Brian to invest? And then when I divest my business ownership, how does that plan play into the plan for long-term retirement? And so there are a couple of key components that are happening now, and just kind of things that people may not be aware of that will be impacting the money you gain from your business. And oftentimes overlooked, it's your taxes. What will you be paying in taxes? What are the tax rates now? And how is your business taxed when it's sold? So currently, you have two components. You have federal, and you have, to a lesser extent, depending on where you're sitting, you have state taxes. Currently, most businesses, you have one of a couple buckets. You have either long-term capital gains or capital gains taxes, and those are typically lower than your ordinary income. So when you sell your business, you're going to be impacted. You have to pay capital gains tax. Right now, you're at historic lows across the board when it comes to federal and state taxes. And in 2021, we know what those rates are. Beyond 2021 and what we see coming down the pipeline, tax rates are going to increase. So as you're planning for the exit of your business, it is very important that you do plan for tax implications. What will happen if I sell my business in 2022, 2023? What are the rates potentially going to be, and how does that impact your long-term plan? Meaning, if you're not receiving as much money as you would this year because tax rates are higher, then that is something that you need to factor when you're working with someone like Brian, your long-term plan. So one thing that's on the docket right now in Washington, which is new, is a Washington capital gains tax. It has actually passed in the Senate, has passed, and it is in committee. We don't know exactly what's going to happen with the rates. I've heard 7, I've heard 9. There are different thresholds for the size of your business, whether or not you are exempt or not. All of that's kind of up in the air and still being, I guess, debated. But it is new and it is coming. So that is something that you have to consider as a Washington resident, that this year and the years before, you didn't have a Washington capital gains tax as it applied to this sale of your business, but that is coming down the pipeline. And so, not trying to plug myself or, just the idea of selling your business in 2021. But if you're on the fence and you're thinking, well, maybe this year, maybe next year, one thing is certain: we know what the rates are this year, and they're historic lows. In the future, they're definitely going to increase, both federally and Washington. So then, the second question we generally get from clients or individuals looking to determine the value of their business is, how do I maximize the value, and really, how do you value a business? So starting first with maximizing value is really about what you take out of the business as a business owner. Every type of business, whether you own a law firm, a widget factory, a CPA firm, it all is different depending on the industry. So there's rules of thumb for each of those type of industries, but the general math or the techniques that you use to value the business remain the same, just the multiples might be slightly different. So maximizing the value of your business really turns on how much cash you as the owner are taking out of the business. So first of all, kind of looking at how do you maximize your value? So number one, you want to have a positive trend. So one of the pitfalls people fall into as they're considering their business and winding down is retiring in place. or slowing down or making decisions that impact the top line revenue in a negative way. So what I generally say is, if you want to maximize the value of your business, run it as if you're going to own it for another 10 years, because the person who buys it will. So that is making key decisions for growth, doing the things that will increase top line revenue and ultimately increase your bottom line income. And so that when you are ready to sell your business in a year, 2, 3, 4, or 5, you have a nice positive trend. So that's one of the first things that generally people are asking as they're thinking to wind down. What should I do about these business decisions? Make the decision that is best for the business. And so that when someone comes in, you're handing off something that is growing and vibrant versus something that is starting to maybe stall or become kind of flat.
Hey, Justin,
yes.
Got a quick question for you, going back to the capital gains issue.
Sure.
If somebody sells their business on a contract, when does the capital gains apply?
That's a great question. So disclaimer, I am not a CPA. I just play one on TV. But I can tell you generally how capital gains are realized. So what the question is implying is more of an installment sale. So let's say your purchase price is $1 million, and you sign a contract today that says someone is going to pay you $1 million for your business. If you receive $1 million today, then you will, on your next tax return, right? Because this is 2021. In 2022, when you're filling out your taxes and you're talking to your CPA, you will realize a gain, or again, I'm not going to talk about basis and that sort of thing, but you would have $1 million purchase price, and then you'd be taxed on that $1 million because you did receive it on a day in 2021. The second, we'll get into the structures later, but the second part of this is, okay, what if I got $1 million, but they're paying me $10,000 a month, right? For 100 months or whatever the math is, don't quote me on that. So you are realizing, so if you got $10,000 a month from March through December, right, you would then next year be taxed on the $10,000 a month each month you received in 2021. So how does that impact capital gains? Capital gains rates are varied, not unlike your ordinary income. There are different brackets. And if you are in a certain threshold, you get taxed slightly higher. So to a certain extent, if you spread your payments over time, you are going to be in a lower tax bracket because your income on that transaction is lower. So you could be saving taxes by spreading over time, with the caveat, if the tax rates remain the same. If the tax rates jump up to what the Fed is currently suggesting, in some cases double, that might not be the best strategy. It might, like going back to my point, I think, Wendy, you asked, we know what the rates are in 2021 and their historic lows. They will go up by 7, 8, 9, 10% is what I'm seeing on reasonable estimates. And in some cases, they're going to be even higher, almost twice as high on the top end of that range. So installment sales are great to spread your tax over a period of years. But if the tax rates go up, it may end up being a wash, or you may be losing out on paying more taxes.
And Justin, just to add to that, there's also the opportunity cost if you stretch those out too far, right? If you have a 10-year contract sell and it's the same dollar amount over 10 years, what's the cost of that versus maybe a lower lump sum amount in the first year? So those are all things that have to be calculated, right? When you're doing the present value of the sell price.
Absolutely. Yep. So generally speaking, more money now is better. Yep. And okay, so thank you for the question. Jumping back into valuation techniques. So there are kind of 3 different types of valuations, or 3 different numbers that you're going to be looking at when you're valuing your business. Not all are weighted the same, and I'll explain why. So you have your EBITDA, which is your earnings before interest, taxes, depreciation, and amortization. There is a quiz at the end, so you need to write that down. But that is what most investors, most buyers, most bankers are going to be looking at. And what that really is how much money are you taking out of the business? and what the return on someone's investment will be when they buy it. So let's give an example. If your EBITDA is 250,000 and they buy your business for $1 million, you're getting a 4 times EBITDA. And that is, kind of a general rule of thumb for like professional service companies. So as you're looking to try and determine, okay, how do I maximize my value, generally understanding valuation techniques, you really want your earnings, your net income to be on a positive trend. But that can also be misleading to a certain extent if you are, say, like a C Corp and you zero out your earnings every year for tax purposes, your earnings is 0, right? So then how do you get to EBITDA and get a multiple that is positive? Then what we really also look at is something called seller's discretionary earnings, which is owner compensation plus EBITDA. So what we look at when we're, again, looking for positive trends, your seller's discretionary earnings is your compensation, your 401k, your insurance, your car, your vacation home in Maui that you use as a second office. All of those things go in when we're valuing a business. It's really an adjustment to your P&L, adjustment to your tax return that says, okay, even if your income is 0 because you're a C Corp, what are you actually taking out of the business through different compensation and different owner perks? And that becomes your seller's discretionary earnings or an adjustment to EBITDA. And so again, depending on the industry you're in, professional service companies are valued in a certain way versus, like I said, a widget factory or a software company or something like that. But again, if you're looking for, okay, how do I maximize the value when I look to sell my business, you want to have really positive trends when it comes to your EBITDA and your seller's discretionary earnings, what you're taking out of the business. And then from like an SBA lending point of view, as far as valuation, I mean, one of the things that SBA lenders are looking for, and currently in the trends today, is what impact did what impact did COVID have on your business? And so a lot of people are approaching us and they're fearful that, hey, I had a downturn because of COVID, I can't sell my business. That's actually not true. If your business is rebounding, if you had that blip on the radar because everyone else did as well, and now you're getting back to pre-COVID levels, or you're higher than pre-COVID, or you're even trending back to pre-COVID levels, we can actually adjust out. It's called an adjustment. You look at that window in time and say, hey, this is a pandemic. We just kind of remove it from the equation, and then we revalue the business as if that hadn't occurred. So again, if you're fearful that the numbers don't look right because of COVID, if your business is rebounding and it shouldn't be an issue. If your business was impacted and the new normal is a lower threshold of revenue or EBITDA or SDE, then that would impact the valuation moving forward. But again, those are things that we would address in any type of valuation, a deep dive. So deal structure, this kind of goes tying back into the earlier question about what if I take payment over time. So deal structures when you're selling a business, this all goes into the holistic planning, right? What tax bracket are you in? How does taking a certain payment in a given year impact the amount of taxes you're paying and your long-term strategy for retirement, the money you need to live your second life, post business ownership. So generally, by default, most sellers are thinking, hey, let's take as much money as we can now. As tax rate change and the lending market changes, maybe that is something that is adjusted. But the different deal structures are generally you have asset sales. If you have a business, a widget factory, for instance, you might be selling to a competitor, and you have inventory of all your widgets, but you also have contracts and accounts. So you'd be selling those assets. That's one deal structure. Then you have the actual company itself. So whether you're an LLC, an S Corp, or C Corp, you can also sell those companies as a standalone. And depending on the buyer and the deal structure, has slightly different tax ramifications. Again, so all tying together. But as you're thinking about your transition, kind of going back to those questions I had, how long do you need to work? How long do you want to work? How long would you be part of a transition? As you are preparing your business to transition, you are a key cog in the works. You have institutional knowledge, you have referral sources, you know where the bodies are buried. These are all things that a new owner needs to learn over a period of time. So, and the second kind of drop down here, transition as a valuation tool. Generally speaking, the longer you're willing to transition the business, kind of sidecar next to the new owner, the higher the value they will receive and the higher the value you will receive as far as compensation, purchase price. Giving someone the keys to the castle and leaving today, likely to impact your value. You're not going to get as high a value because the risk to the buyer of anything happening, they find the skeleton on their own and not realize it's there. Those things impact value, and so that creates more risk. And so generally, the purchase price of the value goes down. So again, these are all things you need to start thinking about: is how long do I want to stay involved with the new owner, with the eye on maximizing the return on this business that you're selling. The lending landscape right now is incredibly buyer friendly. Money is exceptionally cheap. Interest rates are all-time lows. There are several loan programs under the CARES Act and the Economic Aid Act that are encouraging lending. And so what that means is that buyers are being pretty aggressive. You're actually offering better deals because their risk is lower, right? They're getting a product from a bank that is, in some cases, relatively cheap, if not free money. There are some really nice programs out there. So again, going into the deal structure, what does that mean to you? Generally speaking, you can expect 70, 80% of your purchase price in cash at closing, and then have some what's called seller financing or a promissory note that's paid over time. So you kind of have a best of both worlds. You're getting cash down. You're also being able to spread some of that cash or those payments over a period of time. And so you can have a pretty favorable tax treatment there. Okay. So this is one of my fun slides to talk about all the things you shouldn't do. But generally,
you shouldn't shake hands right now.
Number one, definitely not shaking hands. This is not COVID protocol correct here. But there are a couple of key things that business owners, maybe the pitfalls that you step into, that you're all here, you're thinking about your plan. If you avoid these few things, the transition of your business will be even smoother. And I'm going to start with the self-serving one. Not having a team to help you. I don't know how many times I have helped someone who's either tried to sell the business on their own and failed, hired someone who wasn't a specialist or didn't know how to actually sell a business, or frankly, took too long to try and bring someone in a negotiation. So, again, just like you are an expert in widget making or an attorney or CPA, you wouldn't expect your clients to do those things, right? You should not be expected to know how to sell your business, value your business, and transition the business. So putting together a team of advisors like Brian to understand, okay, what do I need? What do I need out of my business to actually hit my goals? What are the tax ramifications? What kind of taxes am I going to pay when I sell my business? So these are things that putting together a team is crucial when selling your business. Another thing that I generally say is kind of a pitfall is not understanding, where the buyer is coming from, right? If you're looking to sell your business, I think it's very important to be collaborative. Understand not just your goals, but what are the goals of the buyer. What I find is the deals that are the strongest are when the parties, there's negotiations over price and structure and that sort of thing, but really when you are treating the buyer as your successor and your team member. So really having that collaborative approach to make sure it's a win-win, that generally makes the deals go much smoother. And not understanding value or selling yourself short. that again, that kind of goes to that trying to do it on your own. If you don't understand the value of your business, either you have too high expectations or too low. You're either leaving money on the table, or you're never going to sell because you're not understanding what the market is, and your expectations for the value of your business are too high. So again, before you ever test the market or try and sell your business, always say, hey, gather the information, put together the team, understand what you need. And if you need $5 million from your business, but it's only worth 2, then you know that the timing's not right. So those are the things you have to do early on so that you have a goal, you know what you need out of the business, but you also know what the value is, so that you can, again, going back to that initial slide, it's a cycle. You understand how all the puzzle pieces go together. And those things I find are the most beneficial when you're ready to actually transition your business. So those are the main points I had there. Any questions or comments from the audience?
So is it possible then just to reach out to you or Brian just to get a sniff for what our businesses might be worth? Is that the best? How do we start?
Yeah, for sure. So we can help you determine the value of your business in a couple of different ways. Generally, we'll do something called a valuation snapshot, ask some general questions about your business and the trends, and be able to give you an idea, regardless of the type of business you're in, what the valuation or the sale price could be. And you can just reach out, information here, direct email, or give us a call. And just a few documents we need and a couple days to run our analysis, and we can give you like I said, a snapshot of what the business is worth.
What does it cost?
Oh, so valuation snapshots are free. So that's something we do just as a general information, just to provide for as you're trying to plan. We do $2,500 opinions of value. So again, that's just that's a document you can use for succession planning. So yeah, feel free to reach out if any of that sounds of interest.
And then if it is of interest and somebody wants to retain your firm, Justin, then how does that play out fee-wise?
Yeah. So standard broker's fees, we're paid based on success. So if we sell your business, we have a sliding scale of fees. It's 10, 8, 6. That's pretty standard in the brokerage business. But depending on the size, obviously there's a sliding scale. So the larger your business, the fee actually slides down, and the smaller, the most we would charge is a 10% commission.
Any closing comments you guys want to offer?
I would just piggyback on a lot of what Justin has said, and specific to timelines. I think Justin and I are in the same ballpark. The sooner you start planning for this stuff, the better. Ideally, a 5-year time frame is a good window to look at. Certainly, you can do it shorter, but the 5-year really gives you time. If your EBITDA isn't where you want it to be, it gives you time to adjust it to maximize the sell value and to have maybe those internal conversations if you're talking about selling internally or whatnot. So I think giving yourself ample time to really situate yourself and situate the business is critical to a successful transition.
Absolutely.
When somebody commits to selling their business, is there a typical time frame in which that can get done? Is it all based on supply and demand, I guess? Whether there's buyers out there.
So timeline, again, with our business, if our clients are ready to make some sort of transition, we generally say, give us about a year from start to finish. So again, as you're working backwards in your timeline of, if there's 5 years of run rate to get you to your retirement, let's say your goal, with us, we generally say it takes about a year to sell the business and plan for a year of transition. So about a 2-year window, right? So just because you list your business March 1st, doesn't mean that it's going to sell March 30th, right? So generally plan for, like I said, a year. So if you want to be done, plan for 1 year of us trying to find a buyer and getting a deal put together, and then expect the buyer to want you to stay on for, I would say, 6 months to a year as some sort of transition. So, you know, if you're working backwards from your drinking Mai Tai on a beach in Hawaii, you have to keep that in mind. You have that 1 year pre-closing and 1 year post-closing.
Wendy says on the chat stream, sales and gifting to family and or employees. I don't know how to,
That is
that's just a topic you can jump on.
First lawyer joke of the day, objection, compound question.
Right.
So that, Wendy, I would say if you want to just ping me directly to kind of flush that out, I'm happy to do that. I mean, I have not done a transaction that involved gifting, but I have done sales to family and employees, but never on the same transaction. So really trying to determine what your goal is, and then we can kind of work through that. But there are some interesting perks to gifting a certain amount of ownership in your business. I'll just throw one anecdote out here. So if the buyer of your business owns 10% equity in the business at the time of closing, and that equity is vested for 2 years, then they will have a 0 down payment when they go to get a loan. Their 10% equity will be considered the down payment. So they will not have to put a single dollar down other than closing costs to get their loan. Now the purchase would be for 90% of your business, not 100. So the valuation would be 90% of the value because these people own 10%. But if you're looking for a way to incentivize your employees or family members to buy you out, and they're concerned about a large down payment because their down payment would be 10% under most SBA loans, that is one way to do it. I agree. Interesting indeed, Wendy.
Interesting, yes.
Yeah, there's a lot of, so there is I know we've only had about 45 minutes here, but there are many permutations of how to transition, sell your business. It's a puzzle, and everybody has a different picture and therefore a different puzzle to put together. So if you have specific questions related to your business and your plan, reach out to Brian, myself. Happy to collaborate and put together a structure and a plan so you have a roadmap to your own exit strategy.
We appreciate any closing comments that Brian or Justin want to add before I wrap it up.
I just saw one more question about the timeline for legislation, cap gains in Washington. I just sent a link. It's currently under review. It's everyone's best guess. This tax has been on the docket, as it were, for the better part of 6-7 years. It's gaining traction for various reasons. I think COVID is, it's a shortfall, right? Tax dollars are down because businesses aren't paying as many taxes because the restaurant industry has been devastated. All these things are playing into it. My general spidey sense, don't quote me on it, is it'll probably be something that happens next year, passes next year or the year after, if at all. But again, as it sits right now, there is a $6 million gross revenue kind of exemption. So if your business is under $6 million in gross revenue, there's an exemption as it's currently written. But again, these things are changing constantly, and until it's actually written into the law, there's no certainty. So that's something to think about too. If you're under 6 million in revenue, currently, it's not something you need to necessarily worry about, with an asterisk that could change.
We aspire to be above 6 million.
As everyone should. But if you're underneath it, you're going, woo,
yes.
Win. So
there will be some implementation time, obviously, if the law passes. The state of Washington's never had a income related or capital gains tax at the state level. So I guess it'll be helpful, but it'll take the agencies to get things deployed.
Right.
I also think that there'll be many court cases involved once, and if it is ever passed.
Yep,
Absolutely.
Good point.
that's right. There'll be plenty of challenges to push it as far into the future as possible.
And if I recall, our Washington State Constitution strictly prohibits income tax.
Yep.
That's right. That's right. That's the number one challenge.
Yep.
All right, everybody. We really appreciate your time today. And if you haven't picked up on the fact, Justin and Brian and also myself and all of us at the Vinoble Group and Private Practice Transitions are available to answer questions. We intend to have the knowledge that we have be user-friendly and translate it to the way that best meets your absorption rate. So please keep us all in mind when you might be considering diving into this topic or any of the services that we offer in our firms. Thank you for your time, and we look forward to our next chance to meet with all of you.
Thank you, everyone.